All right. Here we are back with a special edition of my Monday Live, 3 p.m. Pacific Standard Time instead of 6 p.m. So we'll see if it's a good time. Maybe we'll switch it up and we'll go a little bit earlier. I know for myself, getting on here at 6 p.m. Pacific Standard Time after working for 12 hours, sometimes I'm yawning. So trial run at 3 p.m. Let's see how this one goes. Hope everyone's doing well. Happy Martin Luther King Junior Day. I know that my kids who were in camp earlier talking about his legacy and all the great things he's done. So shout out to MLK and everything that he did. Let's talk about mortgage stuff. I have some things that I think are important to talk about when it comes to mortgage. As always, you guys chime in with your comments, questions, suggestions for what we should talk about. One thing I know for certain, it's middle of January 2022. Rates have ticked up quite a bit. If I could give one piece of advice as a public service announcement to folks, I would say if you're in the market to buy a house and you got pre-approved, your lender, I hope we do this on all pre-approvals, but I guess all lenders don't. They showed you a loan estimate. They showed you some sort of guesstimates where, hey, you're going to buy it at $400,000. You're putting 10% down. Here's what principal, interest, taxes, insurance, mortgage insurance, all-in payment looks like. Here's what your total cash to close looks like. Please revisit that if you're planning on purchasing, because I know for a lot of people, there's going to be a little bit of sticker shock, right? Rates have gone from near 3% mid-December to 3.5, 3.625. Again, this is going to depend on your credit score, your down payment, the type of program you're using, all that good stuff. But it's going to have an effect on your payment. I want you to be prepared for that. I don't want you to be out home shopping based on a conversation you had 4 to 6 weeks ago. I know I'm encouraging all the folks that I have pre-approved. If they have any questions about what it looks like, feel free to give us a call. And here's a graphic for some people that are visual learners like I am. I think it's probably helpful. Let's see how well we're able to read it if I bring it up on the screen. Not too well, I guess, but maybe I'll zoom in and see how well we can do. On the left-hand side, I have a $400,000 purchase with 10% down and the 3.5% rate, which is probably the average rate for a lot of folks that are buying right now, versus the 3% they might have saw in middle of December. So let's see if we zoom in, if it gets any clearer. Why does that look? Maybe it's just fuzzy on my screen. Hopefully for you guys, that's not as fuzzy as that. But here on the left side, at 3.5%, if we scroll down, we've got a total payment, $2,159, principal, interest, mortgage insurance, taxes, and homeowners, right? All of it, all wrapped in guesstimates, but pretty accurate on what you're going to pay per month. Then if we just change the interest rate, to 3%, what it was a month ago, you see it was about $100 cheaper, $99 to be exact. So for a lot of folks, my hope is that if it was an approve or not approve, or if it was something where you're not going to do it if $100 more expensive, you might have been in a position where it wasn't a good time to buy anyhow. But just know that, right? For some people that are buying at a lesser price point, this change is going to be smaller. For people that are buying at a higher price point, the change is going to be even greater. But take that into account. I don't use this as the sky is falling, buy now before rates reach 5%. It's just, not a very good tactic. I think that what we saw was a lot of talk about the Fed increasing rates in 2022. The market, it felt like wasn't doing much about it, wasn't moving much. And people said, oh, maybe it's already baked in. We kind of expected this. And then all of a sudden, the first week of January, it all came at once. Multiple days where we saw 30, 40, 50 basis points of, mortgage-backed security movement, rates moving higher. So anyhow, is what it is. 3.5, 3.625, 3.75, wherever you land based on your specific scenario. It's not like it's a terrible loan, right? If most people could go back and have their first mortgage be at that low of a rate, they would be ecstatic. A lot of us got a 6.5%, a 7%. Folks that were buying in the 80s were in the teens. So rates are still great, but they have moved. So keep that in mind. Yes, Johnny, 3 hours earlier than normal, 3 p.m. Pacific Standard Time. Me and my lovely wife and my boys are going to see the Harlem Globetrotters tonight. So we got on early. And, truth be told, if it works out and going on early works for other folks, it honestly works out for me. The only reason I did 6 p.m. Pacific Standard Time originally is because I got a lot of feedback when I posted it on YouTube and said, what's the best time for folks? And I think I might have done 4, 5, and 6, and people all chose 6. Who knows why? Especially the folks on the East Coast, where that's 9 o'clock when we're starting. But yeah, my hope is that 3 p.m. is a smashing hit, and we just do it moving forward. Speaking of future lives, next week, I'll have a graphic out and I'll try to promote it as much as I can. I'm super excited. Matt, the lumberjack landlord, awesome dude, is going to come join the channel. He's going to talk to us about his 4-3-2-1 strategy that he has helped dozens of investors get their first 10 units of rental properties within a short period of time with very small amount of capital. How he does that, quick hint, it has something to do with buying a 4-unit with owner-occupied financing, 3.5% down, FHA. I've talked about that, made videos on that. Then refinance that, go find a triplex. Refinance that, go find a duplex. Refinance that, go find a single family. So that'll be super fun. He'll tell you his story. I think he's up to 100 units now. But for most people, going from 0 to 10 would be a huge home run. And if I was 23, 25, 27, truth be told, you can do it when you're 45, but it's even, more exciting when you're younger. You probably don't have, wife, kids, 3 dogs, and makes it harder to live in a 4-plex. Talking about that and how he did it, how other people can do it. It'll be fun. It's a conversation I look forward to. I'm going to record some mortgage content for a course he's putting together. But we'll answer all your questions. We'll have a good conversation and be fielding calls and doing it as we do on here, Q&A style. Cool. All right. So that's next Monday, the 24th. On the 31st, I'm going to have Ryan Lundquist, SacramentoAppraisalblog.com. That dude has got stats galore. That guy's always a wealth of knowledge. He presented at an event I went to last week here in Sacramento. Gold. His information is gold. The way he presents it is awesome. The dude does amazing things with graphs. He's got really cool data from my market. I had it around here somewhere. What did I do with it? Stacks on stacks on stacks of papers. I probably shouldn't be looking through these. It'll take me. Oh, yeah. Cool housing market recap from the Sacramento region. I'll wait until the 31st to go over some of this stuff, but 18 straight months of less than 1 month of inventory. Our median home price here rose 19.6% in 2021. 15% of sales were cash. A bunch of cool stats, and more important than that, him and me talking unbiasedly about what those stats really mean versus using them to spin a narrative and get clicks or get people to come to a website, right? We're just going to talk about, well, this stat says this, but it doesn't mean much, right? Like the decrease in sales under a certain price point doesn't mean that like first time houses disappeared. It means that like as the price points start to go up and home prices appreciate, there's nothing left in Sacramento under 250,000. Stuff like that. So anyway, look forward to both of those. Matt the Lumberjack Landlord on the 24th, Ryan Lundquist, SacramentoAppraisalblog.com on the 31st. Those are going to be good ones. All right, let's jump into some questions. Nate and Jess, thanks for joining. I have a question. Do we really have to put in offers to help fully cover the appraisal gap to compete with other buyers for homes? That all depends on your market. And, speaking with realtors day in and day out and buyers day in and day out, I feel like I've got a really good finger on the pulse for my market. Then I talked to somebody like Kyle Seagraves out in Ohio, and it's not as competitive out there. It's not necessary. For the competitive stuff here in Sacramento where there's no inventory, there's none, right? So the little inventory we have, highly, highly competitive. If you don't write at least an appraisal gap, and for most sellers and for a lot of the competitive houses, it's got to be a full wave of the appraisal. You're not going to be in a position to compete to get your offer accepted. It's unfortunate. I wish it wasn't the case, but it's just the truth, right? Listing agents, I talk to them all the time too and say, hey, what's it going to take? They can't necessarily answer all your questions, but they can give you some insight, right? I had a good conversation last week, and they know, this thing's going to sell for between 545 and 550. They have offers that are in that range. It's not going to appraise for more than 530 or 535, most likely. And that was the conversation I had. So if somebody put in an offer at 550 with a $25,000 appraisal gap, I think the seller would be okay with that. Not likely that it appraises under 525. If it does, so be it, right? But it's one of those things where they don't want to get in a position where you don't write anything in your offer with what happens when it appraises light, because they're almost certain that based on the comps and based on everything they know as a realtor, there's going to be a difference between what it appraises for and what someone is willing to pay. So, that's all market dependent. If you're working with a really good agent, they should be able to lead you in the right direction, and they should be digging. And, that's part of what the great agents do for you. And, they're your advocate when they're trying to get your offers accepted. They're submitting offers, as much information as possible from the list side to say, hey, I'm writing an offer for my clients. They're great clients. They like this house. They've got 10% down. They've got great credit and great jobs. Like, the lender's got them fully pre-approved, and Matt and his team say they can close this thing 22 days. What's important to your seller? Then they're just going to, in most cases, tell them. They really like a quick close. They'd like to have it, 22, 24-day close, because X, Y, and Z, whatever their future plans are. They might need 7 to 10 days of rent back. If you can offer that to them at no charge, that's going to make your offer look stronger, because that's $1,000 saved on their side. And little things like that, where the better job your realtor does of digging information out of the list side on what is needed to get the offer accepted, the better chance your offer has of getting accepted. A lot of times that has to do with the appraisal gap and that certainty that you bring sellers, because that's what that is. An offer that's 550 with the appraisal waived versus an offer at 560 with nothing in there about the appraisal, the 550 is certainty. If it gets accepted at 560 and it appraises at 530, there's nothing in there about the appraisal, renegotiation happens. The deal can fall apart, and the seller doesn't want that. The listing agent who's qualified and the professional who is advising is saying, we don't want to be in position 2 weeks from now when the appraisal comes back to say, back to the drawing board, can we meet in the middle, 545? What do you want to do? We're in contract at 560. That's what that appraisal contingency does, is allows them to renegotiate, unless it says, hey, we're willing to pay $20,000 above, no more. So if it appraised it at 530, then maybe they say, okay, now we're at 550. But not having that in there at all is a risk to the sellers, which in some markets the sellers have to take. In a market like this, in a lot of areas like the area I'm in, the sellers are just in position to say, no, thanks. We'll take 550 with no appraisal contingency. Anyhow, that's that. I get a lot of that. So I feel like I'm able to speak on it because I'm in it all day, every day. Johnny, I think you might see him before the summer. I mean, for a lot of scenarios we're running, if your credit's not perfect, if you're putting 3% down, if you're working with not a broker, you're probably at 375 right now. Even the cleanest of conventional scenarios with the best credit, we're probably at 3.5. So we could be at 375 by February. by this summer, I don't see them drastically higher, but we could be 4%. That's what my crystal ball says. Final answer. Jeanette, hello, hello, hello. Thanks for joining. Drive NYC, thanks for joining. You're probably appreciating the fact that we're on a little earlier. You guys let me know if 3 p.m. Pacific Standard Time, 6 p.m. for the East Coast folks, if this is a better time. So far, we've got more people, I think, than we usually have at the 20-minute mark joining us live. So maybe it's a function of the holiday. Maybe it's a function of this time works better for folks. But let me know. I would love to jump on here earlier. I could get home and dinner would still be warm on Monday nights. So let me know. Going rate right now for 30-year fixed, excellent credit. It's about 3.5, Nate and Jess. And, it's depending on price point, right? At the higher price points, 500, 600,000 down, there's thinner margins because lenders are paid based on loan amount. So those might be 3.5. If you're buying something for 180,000 with 10% down, it might be slightly higher just because there's a premium for lower loan amounts. People don't understand that, but I remember pricing some stuff and being like, holy moly, that's crazy price. Why is this pricing so much higher? It's because there was a loan amount of 110,000. Lenders not make anything on that. So there's a premium built into that. Johnny, your builder said the longest rate lock is 45 days. They're foolish. Am I allowed to curse or is YouTube going to demonetize? All right, let's keep it cool. You can definitely do longer rate locks. Tons of lenders have 6-month rate locks. They're pretty gnarly. You add like a half a point to the rate sometimes to do a 6 month. So I wouldn't necessarily recommend that, but almost every lender has 60s and 90s. To say that their longest rate lock is 45 days, either they're lying or they're lying. One of the two. I've never come across a lender that doesn't have a rate lock, a 60, at least, right? That's interesting. But builders, lenders are interesting. Someone told me if me and wife have a house under our names, it's hard getting a second mortgage. I would need to move her from the deed so she can qualify for a loan on another property. I don't think that was very good advice. If you take her off the deed, I guess it depends. In California, where it's a community property state, like she could be off the deed. You're gonna take her off the deed and off the mortgage. It might be a yeah. You're gonna have to talk to a professional because there's 1,000 different scenarios we could run with. You make $6,500 a month. She makes $8,000 a month. You've got this mortgage in your name. You guys are both on the deed, but you're just on that mortgage. You want to try to get one just in her name. It's an investment property. You don't want to hit her with the debt of your primary. In some states like California, we're going to hit her with the primary debt because it's community property, right? Even if she's not on the mortgage. So talk to somebody. It might be better off that you're both on there. And when two people are on a mortgage, the debt is both yours, right? It's not like you can be on the mortgage and then you're split it. Like I've heard that question a lot recently for whatever reason. It's a $2,000 a month mortgage, but we're both on there. So it's $1,000 her and $1,000 me. You guys are both liable for the $2,000 a month. If one doesn't pay, the other one's on the hook. So you can't split it up like that. But that's a complex enough scenario that run it by somebody. If you want to connect with somebody in NYC, that's where I'm guessing you're at. Let me know. We'll set you up. Happy MLK Day. And in that, my favorite quote, Martin Luther King, I've decided to stick to love. Hate is too great a burden to bear. We need some more of that nowadays. I heard recently it was a really good one. People were talking about like there's red and there's blue and everybody's fighting about what side they're on politically or what side they're on any certain issue. Like, what about purple? What about the blend of the two? I like that the branding's purple. Your J, Joey, is purple. Let's show some purple hearts. Let's just spread love versus all this division and hate, right? Sounds like a plan. All right. Multiple partners interested. Oh, you sent me this, bro. Why'd I click on this? Now I got to answer a hard question. Let me get back with you on this because I want to speak to your specific scenario. And I got your email. So I got you. Juresi, don't you worry. Johnny Coe. Mortgage News Daily shows jumbo rates better. Let me pull up Mortgage News Daily. I can look at what you're looking at. It's not a typo. It's just when they do a survey, and here's some information you're not going to find everywhere. When they do this survey across the nation, 30-year fixed, I look at it and I see like 365 as the rate. As a broker on conventional stuff, I'm probably slightly lower because these rates are even like 365 with some points in cost. And I'm probably 3.5 with less points than they're showing. So I'm below average on that. What they might take into consideration on the jumbo stuff is a rate survey that also takes into account banks who are saying for our depositors with $1 million in assets in our bank, we're going to write their loan at 3.125. And that's what I'm guessing you're seeing is just that jumbo average being pulled down because some banks are doing it at a loss. And that's the truth. There's some banks, if you bring over $500,000, which truth be told, some of these jumbo clients, they got it like that. They're going to offer very sharp terms. And it's tough too, because you might see a 3.29. I think that's what it is, like in the 3.25 range on some of this jumbo stuff. That's an average where in your market, a jumbo loan might be 600,000. And at 600,000, the rate's much higher. But then you buy a $2 million property with 20% down. It's a $1.6 million loan. Somebody's able to write that $1.6 million loan at a lower rate because you only have to make, you got to make 40% of the margin you'd have to make on the $600,000 loan, if that makes sense. Let me give you perspective. $600,000 loan, if the lender wants to make $6,000 on it, they've got to make 100 basis points, 1%. If you're trying to make $6,000 on a $1.6 million loan, you only have to make 40 basis points. That makes sense? 40 basis points is what? 6,400 on that. So that's where these averages might be a little bit off, but yeah, MBA says 3.42 is the jumbo average. And then and then another daily survey says 3.25. Probably skewed because of that, right? Jumbos are a wide range, from in some markets, $500,000 loan is a jumbo, and in other places they're writing them for $3 million. That's my best guess on that, because jumbo's slightly higher on a lot of stuff that we're looking at in California. All right, you've been watching a lot of these real estate investor videos. How many 2 to 4 unit properties exist that everyone is doing this? I guess you're talking about like buying the owner occ 4 units. There's a lot. There's a lot of them. Enough to where investors are finding them and buying them. So, yeah, I think that's your question. You're like, man, all these investors talking about 2 to 4 units and how to, house hack / owner occ these things. All right. 3 p.m. is a smashing hit. I appreciate it. I like it. I like that you guys are all on board with real estate investing. It's like, it's more fun when you got the wife, the kids, and all that to cram into one unit of a triplex and rehab that while you're building your wealth and renting out the other 2 units. So cheers to you guys. Bigger challenge is adding more homes and rental properties. Yeah, I mean, I guess what's the biggest challenge, Nate and Jess? Is it, the capital required to buy the next properties, or is it finding them? Oh man, you hit the dislike, you're out of here. Thanks for smashing the like button. I guess I never mentioned it, but for whatever purpose it serves, smash the like button. Some people say it's for the YouTube algorithm. It makes me feel good when you smash the like button, so appreciate it. Great question. Kyle in PA. Can a Roth IRA count as reserves to the lender? All of my cash is for the down payment. Yes, it can count for reserves. If you're using some sort of like investment account or IRA, you just provide the lender with the terms of withdrawal, which a lot of times you can find it online. If you're with Fidelity or Northwestern or wherever you've got your money parked, terms of withdrawal. Anybody who's uncertain on what reserves mean, you buy a property, especially when you buy an investment property, the lender's going to say, hey, we need 6 months worth of reserves or 3 months worth of reserves on the investment property. So let's say that you own your primary residence and you own an investment property. Now you're buying another one. They might say we need 3 months of reserves on that investment property and that one. If the payment is $1,500 on the old one, $2,000 on the new, and they want 3 months of reserves on each, $4,500 there, $6,000 on the new one, because 3 times 1,500, 3 times 2,000, $10,500 in any account, just to show that the sky starts falling or tenants don't pay or something goes wrong, you've got money somewhere to be able to, hold on to this thing and pay that mortgage payment for 3 months. Sometimes it's 3 months, sometimes it's 6 months. It depends on the lender, depends on your scenario, depends on, your credit profile, all that stuff. But be prepared. If they ask for reserves, you got to have it somewhere. It can be a savings account. It can be some sort of investment account. It can be an IRA. Just got to be able to show the statements for that account, terms of withdrawal. That's usually what they're asking for. Eddie True. Are there any 5% down jumbo options? There are. They're few and far between. The terms are bad from what I've seen. I really think that if you're buying something in the jumbo market, it's probably not a good idea to only have 5% down. It probably means that you might be, out kicking your coverage. Is that what they call it? Or, maybe stretching a little bit more than would be recommended because, the 10% down stuff, there's good products out there. And I even got flack too when I was pitching the 10% down jumbo program that came out in March 2021. Really easy program to qualify for, just followed, conventional guidelines. And I was excited about it. In California, some of these markets, San Diego, San Francisco, others, $1 million is entry level. And so somebody who was doing well, combined income, them and their spouse making $200,000 a year, wanted to buy $1 million house. They had 130 in the bank. They could put 10% down, but to get to a point where they'd be able to put 20% down, it was going to take a few years of savings. So that 10% down program was a great one that I used a lot in 2021. 5% exists. Anytime I've looked at that program, it's such high risk to the lender that in turn for that high risk that they're taking, they're going to charge you a premium. I've seen a rate like in the mid 4s, and granted, it was like 5% down with no mortgage insurance. But besides that, the debt to income restrictions were so tight, the reserve requirements were so tight that it was really hard to get it. So with all that being said, yes, it exists. Is it a great product? I don't think so. Is it a good idea for most to go out and buy $1 million property at $50,000 down? Probably not. Anyway, that's just my personal thoughts on it. Tyler Kidd, my dude. What's up, man? Good to see you. Glad to have you here. I know you're out there doing cool things. Anybody who is looking for video editing work, tube edits. My dude, Tyler, we did a lot of work together when I was first starting in mortgage, and I appreciate the heck out of you, brother. Hope all is well. I know that you're in the market to buy something soon, so let me know how I can help. Unfortunately, the range is 120K in houses of 380K in Georgia. When you mean range, are we talking about the appraisal gap issue where you gotta write it? It's going to appraise $120,000 less than it's in contract. That's the only thing I can guess from this comment. That would be insane if it was that competitive. The range is in 120. Clarify that one for me, Felix, because I'm curious now. Beck, California, the 30-year investment loan, those are in the 4s now. We had a good run. We're in the 3s. 20% down versus 25% down is going to be a pretty big gap. So if you're 20% down, you're going to be probably, I'll run one for you. Let's run one. My guess is that you're going to probably be closer to 4.5 even. If it's 20% down, it gets a lot better at 25% down. So I'm doing 20% down investment property, 760 credit. So not perfect, but good. Excellent, some might call it. You're going to pay a little bit to get a 4.25. That's what I'm seeing for 20% down. If you put 25% down, and just for anybody curious, I'm doing 400,000 with 20% down, and then 400,000 purchase price with 25% down. For an investment property in some markets, people are like, that's a lot higher than I'm buying. For some people in California, that's a lot lower. Closer to 4% if you're putting 25% down, which I recommend. 25%, the terms are a lot better. Not as big of a spread as there used to be. Maybe 150 basis point spread here between 20 and 25% down. So that's that. If you're buying something for 110 and putting 20% down, like those small little $80,000 loan amounts, it's going to be more expensive. But again, like 4.5% when you're borrowing a lot less isn't that big of a difference, right? On 80 grand. All right, Sassy from Georgia. I have some cash out refi money sitting in the bank. What's the best way to use that money for buying an investment home? On cash or invest in mutual funds? I mean, this is a great question. I don't know if I'm the perfect one to answer it for you, but there's a lot of people that are really bullish on mutual funds and stocks and the market. And there's people that are bullish on real estate. I happen to be somebody who's a little bit more bullish on real estate. My wife and I have investments in both places. And I think that's probably your best bet, is to have a little bit of both, right? And not have all your eggs in one basket, all real estate or all stocks, mutual funds, and the like. It probably depends on personal preference. There's some people, and this is a question I would ask yourself, which one do you feel like you know better? Which one are you more comfortable with? Which one gets you more excited, right? For some people, it's like, man, an investment property where I can see it go up in value, where I have a little bit of monthly cash flow every month, where I know every month when I make the mortgage payment that somebody else is paying, I see the principal payment go down. Like, that's cool. I can drive by that house every day in the neighborhood I bought it in, and it's a rental property. And that gives you some sense of accomplishment or feeling like, you've made it. I don't know. Or some people that just say, listen, if I can get a 4% return or a 3% return and there's no risk, I don't have to worry about an AC going out. I don't have to worry about tenants not paying. like that's going to fit better with you and your lifestyle and your level of risk and comfort and sleep easy at night, then maybe that stuff is for you, right? So I think it's personal preference here. I think what a lot of people would probably advise, and the one thing that I will say is having money sitting in the bank when we see 6.8% inflation is not the jam, right? Anybody who's got 100 grand sitting in the bank that has been sitting there for 1 year, it's worth about 93,000 purchasing power wise, right? That's what happens with inflation is your dollars don't erode and you don't show up to the bank and there's 93,000 in there now versus the 100,000 you had, but you've got the same 100,000 in there plus the $9 they paid you in interest. And you can only buy 93% of what you could buy the year before because inflation has made everything more expensive. So that's my 2 cents. Probably was more than 2 cents, but that matches the return you're getting having the money parked in the bank. All right, Drive NYC. I'm with you. 3 p.m. This one's been good so far. I might try it. I'm gonna see if my buddy Matt the Lumberjack Landlord can go on at 3 p.m. next week. I think Ryan Lundquist has got to do 6, so we might do 6 on the 31st. But come February, it might be a 3 p.m. Pacific Standard Time for good. And we're just gonna have to roll with it because we got a good turnout. We're rolling. I like it. I'm gonna be out of here to go watch some basketball with the kiddos. So good. All right. Thank you, Paula. You're welcome, Nate and Jess. Who we got? Are surveys done on all home purchase transactions with mortgages? Wasn't sure if full surveys are required. You talking about appraisals? Because there's certainly appraisal waivers on purchase, 20% down, 25% down. If they've got data in their system, just like on a refinance, they've got data in their system where there's past appraisals, there's 25% down. They're taking into account the credit worthiness of the borrower. All that stuff goes into that algorithm that says 800 credit score, 25% down, a home in a neighborhood where we've got data on the back end that shows, 1,500 square foot houses appraised for 500 to 540. If that stuff all matches, we, get appraisal waivers all the time on purchase stuff. So that's not necessarily required that we always get an appraisal on purchases. No. Carrie, have you ever qualified someone for a second primary residence when they were buying their parents couldn't qualify for the house? Yes. I don't know if I've made a video on this yet, but it's called Family Opportunity Mortgage. I might have recorded it. It's not out yet. I'm seeing more of this. Me and my wife personally did this for a parent. It's amazing. If you have parents that get Social Security or they don't work or they can't qualify on their own, it's called Family Opportunity Mortgage. Let me see if I could pull this thing up. It's amazing. You buy it. You get the same terms as a primary. Man, where did I put that? Family Opportunity. Let me see if I can pull it up in my Dropbox. They don't go on the loan. They don't have to be on title or anything. You purchase it in your name with your credit, with your income for your parents. It's easy. We just did one actually, and just showed proof that the parents couldn't qualify. Here's their Social Security income, $1,200 a month. They're not going to buy anything. We're going to buy it on their behalf. And I think they call it Family Opportunity. Come on, Mateo. Dropbox. Family. What would I have named it? I'm going to find this dang thing because this is a good one. One last place I'm going to look. Certainly you can, Carrie. And I recommend it, right? Maybe it's because I don't know how to spell opportunity. Would that be the problem? Oh, man. Okay, I give up. I had it somewhere in Dropbox, in an email. I thought it was named Family Opportunity. I must have named it something different. But anyhow. A renovation loan product I would suggest. It's really hard for anyone to get an offer accepted with any of these renovation loans. FHA's 203K is the most popular. If you do it with less than 30K in renovations, it's like their streamlined product. More than 30K, it's like the full-fledged deal. If you've got something that's in need of rehabilitation, so it's going to sell at a discount, there's so many people that are buying those and just rehabbing them and flipping them. They're using hard money or cash, and they're closing in 14 days. So to submit an offer, we're using a rehab loan that's going to take 60 days to close. I just don't see those things getting accepted. I know internally at UMortgage, we've got Sean Hammond, one of the best. And, you know, he worked at AFR for a long time, knows renovation products front and back. We've got them available. I just don't know if you're going to have any luck getting those things accepted, right? So ping us if you'd like, and we can certainly look into it for you if you got a specific property or scenario that you're trying to do. But that would be my warning first, is that like it might be tough to get something accepted. Go here to greatmortgagebroker.com, fill out a form. Hey, I'm in Tennessee. Here's what I'm looking to do. We'll contact you. We've got a great team with lead intake that's going to be able to get back to you and get you some answers as soon as possible. That's something that we've worked on the last couple months. We got it dialed in. Greatmortgagebroker.com. Reach out. We'll help you out. I get it, Nate and Jess. And here's something that I would say about that, because this is definitely a conversation that I'm having a lot. I've got real estate agents that reach out to me and say, hey, Matt, can you talk to my buyers and explain to them how it's going to affect their financing? I've made videos. I made a lot of personal specific scenario videos to show somebody you're putting 30% down. If it appraises at 580 and you're in contract at 620, here's what it looks like from a loan perspective. Truth be told, for a lot of people, especially that scenario, putting 30% down, it won't affect them at all. The only thing it affects is in your mind. You got to be okay with one person's opinion of value on one day was 580. You paid 620. Because if you pay 620 and put 30% down, whatever that number is, 620 times 0.7, you're financing $434,000. If you go 580 appraised value, you're still at 75% loan to value from the lender's eyes. Between what you're paying and what you're financing, it's, you know, a 30% down, but it's 75% loan to value based on that 580 appraised value. The loan does not change. The 434, the interest rate is the same. The amount financed is the same. Your down payment, that's all the same. Nothing more comes out of pocket in that scenario, except for that, you know, you paid 580. And here's my thing to buyers. And I'm not just saying it. I personally lived it, bought something in August of 2020, appraised at 430. I paid 460. I know I'm keeping the house for 30 years. I could care less if it appraised at 185. That wasn't the thing. I was willing to pay 460. I wrote the friggin' offer at 460. The agent came to me and was like, man, it appraised at 430. He was upset. Why? I'm not upset. Wife and I sat down and said, we're willing to pay 460. And I guarantee you in 2052, I'm not going to be worried about whether I paid 430 or 460 for it. I'm just not. If somebody's buying something that they're going to sell in 3 years, maybe an issue. If somebody is only putting 3 or 5% down and doesn't have, like, it's going to affect the loan. It's going to require more money out of pocket. That's different, right? But even in the case where somebody's putting 10, 15, 20% down, if they qualify, usually can restructure it where you're going to put 5% down and bridge that gap. Your payment might change a little bit. Mortgage insurance might change a little bit, but we can usually do it in a way where you're not coming out of pocket a lot more, right? It's more mental around it appraised at 417 and I paid 430 because we agreed on 430. That's where it lies. You know, I don't subscribe to any doom and gloom. I don't think that it's going to, appraise at 417 and you paid 430 and 3 years from now those houses are going to be selling for 250. I see no scenario where that's happening, right? So you're getting a 30-year fixed rate loan with a payment you can afford. The house, you liked it enough the day you wrote the offer to offer 430. So whether it appraises at 415 or 420 or 425 should not matter to you, especially if you're holding it for the long term. So that's my honest feedback. And I eat my own dog food because I did it and paid $30,000 above appraised value back in 2020. I feel great about it now because the place is probably worth $550. But even if it went down, I would feel the same. That payment that was attached to that purchase price with the down payment that we did, me and my wife bought it, is something that we were willing and able to do from the start. And 5 years, 10 years, 15, 20 years from now, I'm not going to look back and worry about 430, 440, 450, 460. All right. Rant over. A blast in the past. The bank statement loans or self-employed, type loans, most all I've seen require 20% down. Yes, they're more risk, and these non-QM lenders, wouldn't be taking on added risk of, hey, we're going to lend to you based on a 12-month average of your bank statements and allow you to put 10% down. It's just, it's going to be 20% down, some of them even more. Graciel Menor, Happy New Year to you as well. Wondering how much is a typical refi? If you're looking at the loan costs, which are the first page of the loan estimate, where you've got lender, title, and appraisal and things like that nature, just in A, B, and C, and it shows a total loan costs in D, you should probably be in the $1,500 to $2,500 range. If the specific loan you're getting requires you to pay points because your credit score is lesser, or you're trying to buy the rate down for one reason or another, that cost can be higher. But $1,500 to $2,500 is probably the standard. And then any points added to that, it would have to be that you're buying the rate down, or you're doing cash out and you've got a 674 credit score, something like that. It's really hard to use generalities when it comes to mortgage, because someone will be like, oh my gosh, this lender's charging me 2 points. It's ridiculous. I look at it and go, yeah, you've got a 644. You're doing a cash out refinance, and the rate is a pretty good one. So you got to pay 2 points in that scenario. In other cases, somebody goes, hey, I got this great rate. Look at this. It's a pretty good deal, right? And I say, holy cow, Quicken is charging you 2 points for a rate that we could get you for a half a point. They're overcharging you by $6,000. Bring that to us. Tell Quicken to go fly a kite or a rocket, whatever they want. So yeah, that's long-winded answer and an opportunity to jab at Quicken. So I dotted all the I's and crossed all the T's there. Eddie True. Usually on these 10% down jumbos, there is reserve requirements. I've looked at some of the guidelines on these, and like the bigger the loan amount, the more reserves required. Makes sense, right, for the lender. But at my favorite wholesale lender, it's actually pretty limited in reserves. Let me see if I could pull something up for you here. I'll look at the prime jumbo max for you. See if it's got like if you go over 2 million, they want 18 months of reserves. Below that, like whatever the automated system says we need in reserves, would be required, which usually isn't a ton. But yeah, there's a bunch of different jumbo stuff. Jumbo's opened up a little bit. You can go down to 680 credit score. You've got the 10% down stuff. A lot of these guys will go to 45% DTI, which is good. Yeah, and like it used to be 2 appraisals on all these jumbos. You can go up to $2 million with just 1 appraisal now. So jumbo is wide open. Theo B. I think the short answer to your question is not really. There's always using education to replace that 2-year work history, right? If you went to school to be a nurse, you graduated, now you're 6 months into nursing and you've got a, salaried nursing job, then you'd be able to qualify. If there's no schooling and you're 9 months, 12 months into work, there's not a lot to be had mortgage wise. One thing to consider, which people don't necessarily know, is let's say that you worked 8 years ago and had a bunch of work history, and then you decided to stay home and raise kids, and you took 5, 6, 8-year hiatus to be a stay-at-home pa. You could come back, and there's actually guidelines written in, like return to work, and use the 6 months you've been back plus a year and a half from 8 years ago and say, I've got a 2-year work history. I just was out of the workforce because I was raising kids, caring for an elderly parent, whatever it was. So there's that. But besides that or schooling, I don't think there's a lot of options for, only 9 months of work history trying to get approved for a loan. My plan was to build, but if it'll take the builder 10 to 12 months to finish, is that a bad idea since we have no idea what rates will be? I think rates might be one of your concerns with building, but my guess, based on everybody I've talked to who's ever built a home, maybe the least of your worries. Whether you're 3.5 or 4.25 is probably a lesser worry than like how much it's going to cost you to build, how much permits are going to cost, all the other stuff. For a lot of people, it's like, from what I've seen from my seat, people who build, it's usually like a, what do they call it? When there's like a word for rich people do stuff that doesn't make sense. I can't think of the word right now, but it's not because it's super cost effective. And I don't think right now it's cost effective at all to build a home. I think in a lot of places you could buy and spend a ton of money on rehab and get a better product than you could ground up construction. I think ground up construction from a single person perspective, building one house, it's a luxury buy, right? It's something that where like, sure, if you've got a $10 million or $20 million net worth, and you want to spend 1.5 building something ground up, you can do it. And it's not going to affect you. If you're a normal Joe or a normal Kyle and you're trying to, buy a plot of land, you're going to pay a premium for that. You want to build ground up, you're going to pay a premium for that. You want, a decent general contractor, they're going to charge you a premium. You want, decent fixings on your house, it's going to be delayed in shipment and you're going to pay a premium. So maybe that answers your question. I don't know, but I wouldn't, rates in 12 months. I would, if I were betting, just say 3.75 to 4.25, somewhere in that range. And base everything around that. 120,000 above asking price for properties at 380. That is freaking ludicrous, Felix. I mean, people are looking at Georgia and being like, wow, I can buy a 4,000 square foot house for this price. I'm in. Have they been out there and felt the freaking humidity? I wouldn't live out there for free. Sorry to all my Georgians out there. Beautiful place. My mom worked for Delta in the late 90s. And so I go out there and see her. I cannot live in that. I'm a sweater. I just sweat nonstop. And in Georgia, it was too much for me. But that's pretty wild. The real one. Thank you. I appreciate it. We're having fun. I think we're up to 45 states. We're at 44 a couple weeks ago. I think we're 45. New York, it's hard. Nevada, it's hard. Most states is my final answer. So if you need help, let us know. GreatMortgageBroker.com. Fill out the form. You know what I was going to pitch today? I haven't done this in a long time. I've got a course on Teachable. I lowered the price to $22, and I promise you, Teachable, whatever they take, 7, 10, like by the time it comes to me, it's gonna be next to nothing. I would love if you're interested in really good information, like Home Buying 101. There's 500 videos on my channel, and you could go through them and try to find the 5, 10, 15 videos that best help you in the home buying process, how to read a loan estimate and all that other stuff. Or you could spend $22 on this course. I think after looking back at it, because I literally looked back at it last week to say, how can I put together a video that like skims through all this stuff? Home Buying 101 video is coming out sometime this week. Go there, buy it. If it sucks, just return it. Tell me I'm an idiot. But I'd love some feedback on it. If I get good feedback on, hey, Matt, this was great, but what about this? I wish you would have added this. I'll go in there and add more to it. I really want to know what people think about it, because if it's good, and I think it is, I'll push it more. If it's good, maybe I'll give it to home buyers who we end up working with from the start to say, here's something to answer some of your questions. Here's something that might help you. But either way, I made the course. I did it because a buddy of mine, Mike Zuber, wanted to add it within his real estate investing course. And I haven't promoted it or pushed it at all. So check it out if you feel so inclined. The price is down to $22 for 2022. All right. Enough of that friggin' selling stuff. Yeah, Jeanette, if you're in Northern California like me, it's postcards, it's texts. I had somebody text me, and it's funny because we were talking about the house I bought in 2020. It was for that house. I paid $460, and I think it probably is worth $550. They were texting, and I told them make an offer just for fun, and they said $390. So you're right, they're out there. All right. Yeah, I think that's probably the right attitude to have, right? Like if it's the one, if it's your forever home, they're not going to be 6%. I can almost assure you that, right? So, they're going to fluctuate. They're going to tick up. They're in the mid threes. They'll probably be 4, by the time that the year is over, but still at 4%, it's a great rate. Some of the stuff that I've seen shows that if the Fed does what they've promised, and they push to rein in inflation, we might see some sort of recession turned into lower interest rates over the next, I don't know. I think Barry Habib might have had a shorter timeline than I would think, but who knows? Maybe 18 months from now, rates are back down to 3.5. Rates are back down to 3.25. Who knows? Yes, do that. I mean, it's sweet. You get to basically get the best terms out there, owner occupied, put 5% down or whatever you want to put down. Help your mom get into a house. I can tell you, it's a pretty sweet feeling to be able to buy a parent a house. Tamara Garrett, thanks for joining. What do I think of agencies that say they'll buy your home and then rent it back to you so you don't have to move? you have a home that you own that you are in trouble with or don't want to make the mortgage payment. I mean, it's probably anytime a big company, I don't want to blast any big companies because I don't want to pick any fights. But they're doing that as a business, Tamara, is my initial thought, right? They're going to make money. They're going to see the upside. They know that owning real estate over the long term is a winning proposition, right? And so if they buy it, rent it back to you, let you make their mortgage payment, or the payment on the house, and they get to see all the benefits, the appreciation over time, the debt pay down if they've got debt on it, whatever that is. I don't know if there's many scenarios where that's best for you. But I guess we'd have to yeah. Jin Gao subscribed last week. Thanks for the kind words about the great information. Do I offer any programs for LO training or mentoring? Not yet, but what's funny about that is I literally recorded a video today. I told the marketing team more loan officer facing content, more realtor facing content, where if nothing else, there's going to be some content aimed at loan officers, realtor partners, on how to grow those businesses, because I just think that being in it, as long as I have, I've learned a few things. And if I can help you or help anybody else as a loan officer provide more value and help more people, it's a way for me to help exponentially more people, right? If I talk to 1,000 people in any given year and close 500 loans, I get to directly impact those people. But if I talk to 100 loan officers who each do 100 loans, that's 10,000 people that get affected. So could be more of that in the future. I think that, at some point, all of us start measuring impact over income. And if that's a way I can make some impact, then let's do it. I'd look at it, Carrie, side by side with, the PMI. In a market like this that's appreciating, nobody knows what's going to happen 22, 23 and beyond, right? But paying a higher interest rate or paying a bunch up front to buy out of the mortgage insurance might cost you more than just letting the market get to a place where you're at 78% LTV, which is where most of them are going to have it automatically fall off. Not a bad idea, but I wouldn't necessarily just go for that right off the bat. Look at them side by side. If it cost you $4,700 to buy out the mortgage insurance, but the mortgage insurance is only $92 a month, then maybe you don't buy it out, right? Because then that's betting that it's going to take you 55 plus months to get out of it. I just did, a guesstimate there. So if my math was off, forgive me, but 4,700 divided by 92. We got to see how close I was. 4,700 divided by 92. 51. Okay. I was close. So I still got it. Just compare them side by side and then do a break-even analysis. Maybe we flatten out. Maybe real estate's not as crazy in the next couple of years as it has been. And so maybe it's a good idea. But yeah, look at them side by side to be able to make that decision for sure. Gerard Alava. You're welcome, man. Real estate learning. I like it. Eddie True, hit the like button. Smash the like button. Hopefully this hour was as good to all you as it was to me. It was enjoyable this new time. I like it. I'm going to get with Matt and see whether we want to do 3 p.m. Pacific Standard Time or 6 p.m. Pacific Standard Time next week. If you catch this on replay and you're like, Matt, I expected you at 6 p.m. What happened? 3 p.m. It was a one-day thing, which might turn into a permanent thing going forward. We shall see. I would love to do 3 p.m. Pacific Standard Time. As always, appreciate the heck out of everybody who joined. I really enjoy this stuff. So continue to tune in, continue to ask questions, continue to ping me on any video you see with Matt. What do you think about this? I try to answer as many comments as possible for certain. Like if you join live, I'm going to answer them. And if you have any ideas on any videos you want to see, any topics I haven't broached, as a mortgage broker who talks to people day in and day out, whether that's the consumer, whether that's real estate agent, whether that's other mortgage professionals, I'm always going to give you my unbiased opinion on what I'm seeing and feeling in the market, what's coming up ahead as far as mortgage regulation goes. As a real estate investor, I can give you real life examples, not only from investments me and my wife have made, but also investments from the thousands of clients that I've helped with their real estate investing journey. Good, honest advice that hopefully helps somebody, right? That's what we're aiming for. So thanks for watching. And until next time, we gonna see.